How are you, Galen?
I'm good. How are you?
I'm good. I'm good. So I got some awesome positive feedback from the last video we did about incorporating. So I thought we would sort of expand on that and talk about how people can save taxes using their corporation. So do you want to walk us through sort of the basics on how people can use their corporation to save on income tax?
Absolutely. Yeah. And thanks again for having me and having this conversation because it's something that I find people are typically somewhat confused about how it works. And I always strive to make it as simple as possible. I put on my master's in education teaching hat from my background of education and make things simple. So I'll be doing a whiteboard drawing today to kind of map it out, make it simple for people. So before I open the whiteboard, what I will say is that a lot of times people think it's kind of automatic. Like when I ask people, why did you incorporate? And they'll say, oh, I did it to save taxes. And I'm going to walk through today how you don't automatically save taxes when you incorporate. You actually have to do some strategy. Like there's some active things you need to do to save the taxes, but I'll talk about how that works and from the financial planning side, because one thing I should point out is that when people incorporate, there's tax implications, there's legal implications, and there's financial planning implications. And I mostly talk about the financial planning, and today it'll overlap a bit with the tax side of things. So I'm going to share my
Okay.
screen and map it all out.
Okay.
So what I like to talk about to make things simple for people is, when I meet people who haven't yet incorporated, they're making money in a way that's just sort of direct and they don't have a lot of control over it. So, real estate agent sells a house. I'm going to use round, rough numbers today and simple numbers to make it easy. What I talk about is I talk about the last $100 that someone makes. So in Canada, we have tax brackets, and the more money you make, the more taxes you owe. And a lot of people end up in the 40 to 50% range of the last $100 they make is taxed, usually in the 40%. If I'm talking to a real estate agent that's doing some business, selling some houses, then obviously the prices have gone up in the last few years. We're talking about a 40-ish to 50-ish% tax bracket on the last $100 they make. Now, so if someone's not incorporated, they make that money, and basically, and I know not everyone's in the 50% tax bracket, but I'm just going to use it as a simple one. They have
Okay.
to pay 50% taxes. So $50 of it goes to taxes, and $50 of it goes to their bank account, right? To their genes, so to speak. And realtors, of course, have lots of different ways to write things off and all that. So I'm not going to go into that, but just basically $100 comes in, 50% of it's going to go to taxes, 50% of it's going to go to you, like 50-50, right? For the last $100 that someone makes. Now, when someone incorporates, so I usually draw the corporation as a circle, and I'll just call it the corp. When you incorporate, what happens is one of the biggest things that happens is you have far more flexibility as to how you get paid. So yes, there's tax savings, but there's also a lot of flexibility. Like if someone incorporates and they make a lot of money in 1 year and they don't need all that money to live off of, they don't need all that money like for their expenses, they don't have to take it as salary. They can actually leave it behind to work for them instead of it coming out and being taxed. So that's one of the big things is flexibility. And then the secondary thing is taxes, which I'm going to talk about right now. So once someone's incorporated and they make that $100, corporate tax is about 12% in Ontario. So I'll just use that rough number. So you still have to pay corporate tax, which is, $12 goes to taxes, and 88 lands in the corporation. So people might think, oh, I've automatically saved some taxes. Well, not technically, because when you go to take that, you've saved money on the taxes that you're going to use to run your business, in the sense that this $88 can be spent on business expenses because it's inside of your corporation, but you couldn't use that $88, let's say, to go on a vacation. You couldn't use that $88 to, like go on vacation is a good one, like personal expenses. Like you wouldn't be able to go and spend that money on groceries, for example. So you still have to take the money out to use it personally. And the CRA makes it such that this number plus this number is going to equal pretty much what you would have been left with if you hadn't incorporated. So you're going to get taxed again personally, and then you're going to be left with $50 again. So sometimes when people see that, they say, oh, maybe I shouldn't incorporate if I'm going to be left with the same $50. But there's something important that I'm about to talk about that makes up for that difference. But I want to pause here in case you have an initial question. I know I'm going a little bit fast through this.
Oh, this is, I didn't know about this is news to me. And I've
Okay.
had a corporation before and I didn't know this. Okay. So it ends up working out about the same.
About the same, yeah.
Until
So yeah, go ahead.
and throw your tricks in there. I'm assuming you've got some investing tricks you're going to throw at us.
Yeah, for sure. So
Okay.
so you're left with the big, pretty much, like a lot of people think, oh, I incorporated, so I'm automatically going to save taxes. Now, what the Canada Revenue Agency has done is they've come up with something that basically equalizes. Like, they didn't want, if you put $100 into a corporation and then took it right back out, they didn't want there to be an advantage to that. So they kind of leveled that out a few years ago. Now,
Okay.
and I'm going through rough things, like, if you went to an accountant, they'd go into more details about your specific situation. And I always tell people, don't make any changes based on a YouTube video or a Facebook Live. Like, you need to understand, someone giving you advice needs to understand your specific situation always. But also, I'll talk in general rules. So that $88 that's left behind, the beauty of it is, if you don't need it today, like if you don't need it this year, you get to leave it behind and you don't have to pay that second layer on taxes of it yet. And this is really
Right.
great for self-employed people, because when a self-employed person goes to retire, they don't usually have a pension. They might not even get that much CPP in retirement. So they, over the long time frame, if they've saved money inside of their corporation, they've got a place that's holding money that is pre-personal tax that gets to grow while they're waiting to actually need it. And so it works as a really great retirement vehicle if people use it the right way. Now, so this $88, like I said, if you take it out personally, you're going to get taxed on it. And if you're not careful, it's also going to get taxed in other ways. Like, so if you take that $88 and you invest it inside of your corporation and it grows, and if you don't do it in a way that's strategic, you're going to get taxed as it grows. So A, as it grows, and B, you're going to get taxed when you take it out. But if you put it inside of special and types of investments, and I'm not going to go into what they are today, but it's just, the important thing is that people know that, like, if you're not strategic with the money that you leave behind in a corporation, it's going to get taxed in the highest level possible from dollar one, because the CRA doesn't want people just to willy-nilly keep money inside of their corporations, invest it, and avoid taxes. So you have to use special tax saving strategies inside of your corporation. So if someone's not being strategic, their money gets taxed as it grows, and then they get taxed as they go to sell it. Now, even if they're dealing with this, sometimes it still makes sense to incorporate and still makes sense to defer the personal taxes. But if you're being strategic, you can either minimize or eliminate A, and you can actually minimize B if you have a multi-year strategy on how to get that money out. And I mean, we want to keep these videos short, so in a future one, I can talk about what those investments are. But that's how you actively save taxes in what's left behind in the corporation, is you put it into tax efficient vehicles inside the corporation.
Okay. So a self-employed person can use their corporation as retirement savings.
Yep.
A way to, essentially. Okay. Well, that's cool.
Yeah, and I'll quickly say, like, one of the things, so when I talk to people about incorporating, I say that, every Canadian has access to different different accounts, like the RRSP, the TFSA, like everyone has access to those, but people who can incorporate have access to a new thing or a different thing that's the corporation. And so I say, like, if you think of your financial well-being as a ship, everyone's got access to some of the same tools like RSP and TFSA, but when someone incorporates, they have a new tool on their ship. And so and if they're using it properly, it acts like a sail that will speed them up towards their financial goals. But if they're not using it properly, it can actually act like an anchor that slows them down. So when I work with people, we look at, how much should you keep inside of the corporation? Should you still be using the tax-free savings account? Should you still be using the registered retirement savings plan? Or should you be using non-registered? Like, there's all these different options. And my job when I work with people is to figure out the answers to the question, how much should I keep inside here? Should I still be using this? Should I still be using this? Should I still be using this? And the last thing I'll add, which could be a whole video in of itself, which actually would make a lot of sense, is, actually, I'll draw it slightly over here, is debt. So it's not debt. A lot of times what people don't realize is the beauty of being incorporated. Debt, everyone has different relationships with debt, but it can make a huge difference if people are actively taking money that they don't need to live off of, but paying down debt faster than they need to. in this low interest rate environment, it can actually be a huge negative impact on their finances. But anyways, we could do a whole video about that.
Maybe we will.
Yeah, I'd say so.
Okay. Okay, well, that's really interesting.
Yeah,
Okay.
so that's the nuts and the bolts of like how you save taxes in a corporation, how it plays into the other investment accounts that we have. And the what I'll say is like there's some very rule of thumb things, which is like it makes the more money, the more you're making that you don't actually need to live off of, the more sense it makes to incorporate. And
Right.
you make the most of the corporation by using tax efficient savings vehicles inside of the corporation. If you're not using those, it can also not be as attractive. So that it's most attractive for people who don't need everything they're making and they're using tax
Right.
efficient vehicles.
Okay. So somebody who, yeah, don't need everything they're making and also, are thinking long term, maybe investing for retirement.
Yeah. And the other thing, for sure, absolutely, long term retirement. And the professional real estate corporation can hold property, which is different from a lot of other corporate, like for example, I work with a lot of doctors who have corporations, and their corporation is only allowed to own things that are related to the business or the practice of practicing medicine. So it can own like a clinic that they own, but it can't own like a cottage or an income property. Or
Right.
so a professional real estate corporation is actually a bit different in that aspect. So again, another video we can do as to like how it's what are the implications of it of income property being inside of a corporation versus outside, things like that.
Yes, for sure. Yeah, things are on the mortgage end are a bit different when we're seeking financing for property being held in a corporation too. It's
Yeah.
my job a little bit as well on the financing side. So, okay, well, that's
Absolutely.
awesome. So much, Galen. I learn something every time I talk to you.
Okay, I appreciate it. I love it. I love teaching people these concepts and helping people make sense of their options.
Awesome. All right.
Perfect. Thank you so much.
Thank you.